What should an investor do at the time of market crash? And also, what is the stock market mantra that saves us from a market crash? Industry expert Ms. Amrita will enlighten us now.
Assume you see a facial reaction like this, and the headline is that Sensex has crashed by 1,688 points. 7 lakhs, 36,000 crores of wealth has been wiped off from the market. What will you do? Will you stop investing into equity? Option number one. Or option two, will you check the fundamentals of the equity asset class or product? And if nothing has changed, then continue to stay invested. Invest further amounts in a staggered format, which is like an STP, systematic transfer plan format. What exactly would you be doing? Now that the fact that we understand that there is something called system two thinking, now we are actually thinking logically and we are going for option number two, which is very important. If nothing has changed, there is a famous adage that buy low, sell high. So buy when everybody is selling. That's what smart investors do. They basically invest when a lot of other people are selling, and they basically sell when a lot of people are euphorically buying. So at the peak of the market, a lot of smart investors sell their investments and profit book. And at the bottom of the market, when the quality of the product is very high, when the prices are cheap, is when they invest. So you have to ask yourself that, am I being panic stricken? Am I being overtly anxious? It's good to be anxious. You can't be always chilled out. But you have to check, am I being very reactional? Or should I be responsive? Is my thinking driven by system one, or is it being driven by system two? Can we look at valuation parameters? And by the way, each of these parameters have their pros, each of these parameters have their flaws. But all these PB ratio, P ratio, ROE, they have to be combined. A good combination is PB ratio with ROE, price to book value ratio with return on equity. If you are looking at companies, or if you're looking at the Sensex or Nifty at an index level, then market cap to GDP ratio with the forward P, forward price to book value, price to earnings ratio, forward and trailing makes sense. Forward matlab you are taking earnings estimates for the next 12 months, and trailing means earnings which have been already posted in the last 12 months. So you have to use all of this, or else seek the views of an expert, financial advisor. Keep calm and gauge it in a very holistic manner, and look at if not buying lump sum at market crashes, but at least starting with systematic transfer plans, putting your money into a liquid fund and systematically transferring into equity asset class. That is also a nice version of buy low, sell high.
Thanks for your detailed explanation. Are you in search of a personal guide who can remove the stress of handling your finances? Then please feel free to avail our expert consultation. And also you can attend our webinars to gain investment related insights. Both the consultation and webinar are absolutely free, and you can find the link in the below description. Please like and share, and do subscribe to Holistic Investment.